Hello and welcome to the Business Standard Morning Show. I am Ruchika Chitravanshi. It is 21st of June 2023 and here are the top stories for the day. Can E2W survive without subsidies in India? Is Gurugram the hottest property market in India? What's fueling the rally in stocks of microfinance institutions? And how can you silence spam calls on WhatsApp? The average daily sales of electric two-wheelers slipped into slow lane in June as the withdrawal of subsidies and the resultant jump in prices apparently forced customers to slam brakes on the electric two-wheeler purchase. So what is the road ahead? Can electric two-wheelers survive without subsidies in India? Debarkya Sanyal checks the traffic signal for India's electric two-wheeler segment.
The government had rolled out faster adoption and manufacturing of hybrid and electric vehicles in India or FAME scheme in 2011 as part of the National Mission on Electric Mobility. And about 8 years later, on April 1st, 2019, FAME 2 was launched. The aim was to give incentives for the adoption and manufacturing of electric vehicles. The scheme was extended for 2 years up to March 31st, 2024. The mandate for FAME 2 was to provide subsidies for 1 million electric two-wheelers, 5 lakh EV three-wheelers, 55,000 e-passenger vehicles, and 7,090 electric buses. The two-wheeler segment is close to achieving the target of 1 million vehicles. But last month, amid ongoing investigations against original equipment manufacturers for alleged violation of FAME rules which call for domestic manufacturing, the government decided to reduce the subsidies. It was alleged that nearly every second electric two-wheeler sold under the scheme made false localization claims. Incentive was reduced to 15% from earlier 40% of the EV's ex-showroom price. The maximum subsidy for electric two-wheelers was reduced to 22,500 rupees from 60,000 rupees earlier. The move led to an increase of more than 20% in the average price of an electric two-wheeler, which ranges from 80,000 rupees to 1,50,000 rupees. Ola Electric reportedly raised price by 15,000 rupees for all scooters. Electric bike manufacturer Matter increased it by 30,000 rupees. Ather Energy also raised the prices of its e-scooters by 25 to 30,000 rupees. After setting a record of an all-time high sales in May, India's fast-growing electric mobility segment witnessed a slowdown in the first 15 days of June. Average daily sales volumes of electric two-wheelers declined by more than 62% from May. From 3,395 units sold per day in May, the volume slipped to 1,271 units in June, shows data on the Vahan portal of the Ministry of Road Transport and Highways. Sales of electric two-wheelers made up for 7.73% of the nearly 1.5 lakh two-wheelers dispatched last month. They are now down to 2.65% in June so far. Industry insiders fear, therefore, that subsidy blockade, clawback notices, and embargo on future sales might further dampen the electric two-wheeler sales and even hamper Niti Aayog's target of 2.3 million sales in the segment for this year.
See, Indian customer, particularly in electric two-wheelers or two-wheelers, is very price sensitive. Most of the petrol two-wheelers are sold less than 1 lakh rupees. So direct customer subsidy, if it brings down the electric two-wheeler price nearer to this, there are high chances of a high growth. More you go off from that, less the chances of growth. Therefore, for some time, some years, till the adoption becomes heavy or good enough, the customer has to have a choice between petrol and electric of a similar pricing or maybe maximum 20% higher or 30% higher, not 100% higher.
Experts also point out that the sudden withdrawal of subsidies should be substituted by a gradual phasing out.
The FAME subsidy for two and three wheelers needs to continue for some more time, to enable greater penetration to happen. because currently the segments that are buying this vehicle are not necessarily the segments that will buy it later and will enable the mass penetration to go forward.
Experts say that penetration levels for electric two-wheelers is still low. What then are the major challenges for a quicker adoption of this more efficient and environment-friendly option?
One is mindset. Even at the same price, why only 4.9% conversion was there when there's such a great advantage of running cost, which means there is a mindset still. People buy when they look at somebody else. There is not enough two-wheelers on the road to have a word of mouth. Second is obviously, I told you, pricing. So the solution has to come, how do you generate that money in order to subsidize? Why not levy green tax on dirty fuel vehicles so that enough money is generated rather than taxing Indian customers?
And what then can be some of the strategies that the government and industry players need to adopt to counter these challenges?
Basically, two quick points. One, phasing out in a time-bound manner, and three, the states need to be kicking in. And also the third point, there is to not to see the accumulation of all these subsidies as a subsidy to the sector, but different incentives there.
16 million two-wheelers, petrol two-wheelers are on the road. 85% of them are commuter segment, which is less than 1 lakh of rupees. So one has to concentrate on this price point to convert 85% of the customers from petrol to electric, which means you should not keep on subsidizing luxury goods, for example, which are costing 2 lakhs, 1,80,000, and try to bring them to 1,20,000. It will be a huge amount of subsidy. But if you subsidize the product which are otherwise costing 1.3 lakhs, give subsidy of 20,000, that will be 1.1 lakhs within the hitting range of commuter segment. So one way is to reduce the burden of subsidy. Second is have a sunset clause, but not in terms of time, but in terms of adoption. At around 25% adoption, if it happens from petrol to electric, you do not need full subsidy after that. Then it can be tapered.
Therefore, though industry players believe the subsidy cuts will help the sector stand on its feet in the longer run, they are worried about the near-term future of the sector. Experts emphasize, therefore, that the government and industry need to work together to incentivize a bulking up of demand for the nascent sectors, and only then think of phasing out subsidies.
She'll soon be quoted on the front page. Business Standard.
Indeed, the fledgling electric two-wheeler segment needs a little push from the government to take off. Its increased adoption will also help the government meet its green goals. Moving on, India's residential real estate market is on a fast lane now after a sluggish period marked by pandemic. People are loosening their purse strings like never before to purchase luxury homes. But wait, it is not only Mumbai's beach-facing areas which are costing a fortune. IT hub Gurugram too is on the fire. Ayush Mishra does a reality check. Global economic headwinds may have kept the equity market spooked, but the bull run in the Indian housing market continued in the first quarter of this year, points the latest Anarock research data. Top cities in India recorded new launches of around 1,09,570 units in Q1 of calendar year 2023 against 89,140 units during the same period in 2022, a 23% rise over the corresponding period. The key cities contributing to new launches during the period are Mumbai Metropolitan Region, Hyderabad, Pune and Bengaluru, together accounting for 77% of supply addition. However, a Prop Tiger report identifies Gurugram in the National Capital Region as the hottest housing destination. In Q1 2023, Gurugram witnessed significant growth in new supply with a staggering increase of over 200% compared to the previous year owing to a low base, the report says. A total of 3,284 new units were launched in Gurugram in Q1 2023, with Sector 63, Sector 92 and Sector 93 being the primary localities for new developments. The demand also showed strong growth with a 28% year-on-year increase. The micro markets of Sector 86, Sector 92 and Sector 93 saw the highest number of units sold.
lot of involvement from NCLT, from Swami Fund. A lot of delayed projects are getting momentum. A huge amount of deliveries are happening. That is one of the aspects which is driving the residential real estate market in Gurugram. Secondly, the development of infrastructure, the recently announced the metro project, the Dwarka Expressway, the developments around New Gurugram. These are the factors which are kind of driving.
Gurugram has been one of the preferred destinations among cities for corporate headquarters, attracting not only millennials but also ultra-high net worth individuals from India and around the world. The city has also seen a significant influx of expats who prioritize living in secure, gated communities and a high-quality lifestyle. Average residential property prices across the top 7 cities increased in the range of 6 to 9% in Q1 2023 when compared to Q1 2022, mainly due to increase in the prices of construction raw materials and an overall rise in demand. MMR and Bangalore recorded the highest 9% annual jump. Juxtapose this with Gurugram's Golf Course Road micro-market. It saw an impressive 42% year-on-year and 26% quarter-on-quarter appreciation in Q1 2023. DLF properties on golf links have seen 100% appreciation in 2 years. The rentals across Gurugram are reportedly following the same trend and increasing in the same proportion owing to high demand. According to Prop Equity data, Gurugram has a ready-to-move inventory of only 1,433 units worth 2,885 crore rupees. In contrast, the under-construction inventory stands at approximately 9,912 units valued at 23,104 crore rupees. This highlights the difference between the ready-to-move units and those still under development. The difference in ready-to-move inventory and demand drove up prices.
Gurugram has shown an increase in the property prices, and that's largely because of the lesser number of new launches and limited supply. Majority the impact is in the market is because of the participations of mid and to some extent luxury and affordable segment buyers in the market. Some segments of the investor have also started participating. That is what is riding the growth.
Vishesh Prakash of independent research firm R&R points out that Gurugram presents an opportunity for all stakeholders due to its improved infrastructure, proximity to Delhi International Airport, and availability of luxury properties. While prolonged price stagnation during COVID period has brought an upside in property prices in the region, he shares the other drivers that are contributing to this boom.
Dwarka Expressway saw the highest price increase at 59% year-on-year, followed by Golf Course Road. Similarly, housing prices went up 16% in NCR, with Gurugram being the highest among the top 8 cities in India. The two key drivers of this growth are, first, changed consumer behavior post-pandemic, where the consumers want to now move on from having a house to owning a home. The want for bigger spaces and better quality of life is encouraging willingness to invest time and money in spaces that spell comfort and class at the same time. Second, a very welcome strengthening of infrastructure over the last couple of years is giving consumers a reassurance of sorts, increasing their confidence in the city. This infrastructure boost in Gurugram has given consumers the confidence to go beyond the regular areas and explore setting up their homes in newer neighborhoods. While Golf Course Road remains the biggest hotspot in Gurugram, the consumer will soon witness the Golf Course Extension and SPR, New Gurugram and Dwarka Expressway emerging as the next big micro markets in Gurugram.
In the last 1 year, the real estate sector in Gurugram has seen good growth after 5 to 6 years of prolonged stagnancy in prices. Price correction, rise in demand, and revived supply chain cycle after COVID have led to an upside in the market. While corporates, millennials, UHNIs, and expats are seeking a high-quality lifestyle in Gurugram, the limited ready-to-move inventory has driven up prices, making it a hottest property market in the country. A recent hike in circle rates too pushed the rates of luxury properties in Gurugram. Let us now shift our gaze to the financial markets. Shares of microfinance lenders have surged up to 45% over the last 6 months, even as the benchmark indices added just 2%. In our next report, Nikita Vashisht explains the reason behind this rise and if the current rally will sustain.
shares of microfinance lending institutions, or MFIs, have been steadily minting money for investors over the past few months. Suryodaya Small Finance Bank, Satin Credit Care, Credit Access Grameen, Fusion Microfinance, and Spandana Spurthi have jumped up to 45% at the bourses over the past 6 months. By comparison, the benchmark S&P BSE Sensex has added 2%, while the S&P BSE BankX index has slipped 0.2%. So, what led to this sharp outperformance? Analysts say the massive credit upcycle post the COVID-19 induced slowdown, along with the Reserve Bank of India's new guidelines on microfinance, boosted sentiment.
A healthier balance sheet and a strong demand for credit has been responsible for this optimism. However, the game changer has been the new regulatory changes which came into effect in April 1. Number one, there has been a removal of margin cap, and number two, the household income to get qualified for microfinance loan has now been increased to 3 lakh. What this means basically is that the removal of margin cap would help in aiding the bottom line of these companies, and increasing the household income to 3 lakh would help in aiding the top line. These factors have resulted in a sort of a re-rating for these microfinance players.
According to data from industry body MFI in India, microfinance loans grew 22% year-on-year in FY23 to 3.48 trillion rupees. This was higher than a compounded annual growth rate of 11% seen during FY 2022. Loan disbursals too improved by 23% to nearly 3 trillion rupees last fiscal. This helped MFIs expand their market share to 38.2%, up 331 basis points during the first 9 months of FY23. The market share of banks involved in microfinancing, meanwhile, fell by 430 basis points to 36% during the period. Going ahead, analysts expect strong loan growth in FY24 and FY25, driven by increase in ticket sizes and regulatory tailwinds.
So we feel that FY23 was one good year. There was some growth in 22, but then 23 was one good year where we grew about probably 20-21% in the NBFC space. And this momentum is likely to continue, and we see that 24 the growth would be something around, internal estimates say that the growth will be something around 25%. And the industry has a sort of a good regulatory environment. The interest rate scenario has been improved. So the things look pretty good on.
Against this backdrop, have investors missed the bus given the sharp up move, or does this rally have more legs?
This is an indication that we are probably in the initial stages of a credit upcycle in this microfinance space. However, we can't simply rely on a market upcycle. In case of microfinance players, there is also an element of regional risk, and therefore you would want to pick those microfinance players which have a very well spread out geographical presence in the country. This environment of healthy credit demand and healthy asset quality is expected to sustain in coming quarters as well, and therefore the quality players in this space would continue to be benefited.
Analysts at Anand Rathi Shares and stockbrokers, who recently initiated coverage on the sector, have assigned hold rating to Credit Access Grameen with a target price of 1,421 rupees. They also have buy ratings on Fusion Microfinance and Spandana Spurthi. JM Financial, meanwhile, prefers Credit Access Grameen and Ujjivan Small Finance Bank. Analysts expect re-rating in the offing for the sector amid strong earnings growth and valuations comfort. On June 21st, markets will await US Fed Chair Jerome Powell's semi-annual testimony to the Congress.
He's making plans for an early retirement. Business Standard.
Powell is widely believed to reiterate his views before the US panel, which he expressed in post-Fed press briefings. People in the US are breathing easy now as inflation has dropped by half from last year's peak. Back home too, people heaved a sigh of relief for a different reason. WhatsApp has introduced a new feature which can address the menace of unwanted calls. What is this feature and how can it save us from spammers? Raghav Agarwal explains.
Over the last few months, hundreds of people took to Twitter to share screenshots of unwanted calls from foreign shores like Vietnam, Indonesia, Malaysia, and Kenya. Some of them were cheated too. And it is not just the foreign numbers which are bothering people. On an average, people in urban areas get about 4 to 5 calls a day, mostly from financial services providers and real estate firms. In June, Meta-owned WhatsApp asked users to block and report suspicious numbers. With over 487 million users, India has WhatsApp's largest user base. And now, WhatsApp has announced a new feature called Silence Unknown Callers. It allows users to automatically mute incoming calls if they are from an unknown number. When enabled, the app will silence all the signs of incoming calls from unknown numbers, including sound and visual alerts. However, the calls will be visible on the call list so that the user does not miss an important call. In a statement, WhatsApp said, "Silence unknown callers is designed to give you more privacy and control of your incoming calls. It helps to automatically screen out spam, scams, and calls from unknown people for increased protection. These calls will not ring on your phone, but will be visible in your call list in case it turns out to be someone important." The new feature comes after reports of an uptick in spam calls. On May 11, Minister of State for IT and Electronics Rajiv Chandrasekhar said the ministry was in the process of sending a notice to WhatsApp on the issue. Later the same month, the Meta-owned platform announced that it had ramped up its artificial intelligence and machine learning systems to tackle international spam calls. It added that the system has been able to reduce spam calls by up to 50%. India's telecom regulator TRAI too has asked all telcos to deploy detection systems using artificial intelligence and machine learning technologies to identify and check spam calls. While the government and the regulator try to rein in spammers, WhatsApp's new feature will offer some breather to the users. In addition to the Silence Unknown Callers feature, WhatsApp has also launched a privacy checkup feature. With this, the users will be informed about the privacy and security options on the platform step by step. The checkup covers several categories, including adding additional security to their account using biometric authentication and letting the users decide who can contact them. But how do you stop the unwanted calls on WhatsApp? For that, you will have to open WhatsApp, then tap on the 3 dots on the top right of the screen and then on Settings. Now go to the Privacy menu. You will see Privacy Checkup on top. Tap on Start Checkup. Tap on Choose Who Can Contact You. In the menu, tap on Silence Unknown Callers. On the next page, turn on the Silence Unknown Callers option. You will no longer receive any calls from a number that is not on your contact list.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
A recent survey has revealed that on an average, most Indians in urban areas get at least 5 unwanted calls a day, and over 95% respondents claimed that D&D subscription was of no help. Well, that's all we have for you today. For more news and analysis, please log on to business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.